Good morning, good afternoon, everyone. My name is Charlie Durant and I work for CRU. We're a provider of information, data analysis, events and consultancy within the mining, metals and sustainability space. And joining me today, I have a set of distinguished panelists who are going to delve into the subject of supercycles with me. So joining me today, I have Stephen Motteram from Noble. I have Jason Chang from EMR Capital. I have David Franklyn from Argonaut. And I've got Sam Catalano from Canaccord. So I think in the exploration of supercycles, I think the first and most important question to ask is, do our panelists actually believe we're in one? And I think I'm going to throw over to Sam first. Sam, what's your view on this?
Sure. Well, I think, what supercycle is probably something we can discuss at length during this session. It probably means different things to different people. What I would say is that this time people have started using the fund as compared to, say, the original one at the start of 2003 to 2006, when China really began to accelerate its demand profile for a lot of commodities, feels very different. I think the genesis for that one, I was working in the mining industry in the late 90s, was depressed metals prices, a lack of investment, no one really making any money. And then as a result of that, sort of supply crimping, when we saw demand starting to burgeon from China, that obviously had an immediate flow-through impact into commodities prices. I think that more recently, there's a slightly different genesis for why we've got elevated commodity prices in some areas. And a lot of that comes back to actually the 2015 period, where a lot of the major miners and down to the smaller miners, the listed markets certainly, were punished by institutional investors in particular for over-investing, for having significant capital investment programs. They were seen to be over-investing. So the last 5 years have seen that the whole sort of, outlook for a lot of management teams turn to disciplined capital allocation, how they're allocating that capital both towards projects and with regards to returns to shareholders. And I think that the last couple of years, we haven't seen companies struggling to be able to invest. We've actually seen companies, for the most part, operating companies at least, with significant margin, generating significant cash flows. And I think the genesis of perhaps another super cycle could be more to do with whether the discipline of a lot of management teams is maintained in not actually investing a lot of that available cash into unwarranted projects. Because I think if we continue to see the general discipline, and of course there's a few exceptions to that, over the next few years, then that could be the genesis for another super cycle, but perhaps, as I say, for slightly different reasons to the last one.
Thanks, Sam. I'm going to do a quick round robin on this question because I think it's important to establish where our views are. For the sake of completeness, I'm something of a supercycle skeptic, but I will wait and see if I can be convinced by some of the panelists here. Stephen, what's your view on the supercycle and whether this is one?
Yeah, I think if you think about a supercycle, it implies all commodities rising for an extended period of time. I think the current phase we're in is a bit more nuanced than that. Beyond the current supply chain issues with COVID, stimulus driven rallies in iron ore, etc., which has obviously come off. There are pockets of commodities going forward that will be driven by different cycles in the long term, but I wouldn't say it's widespread enough to call it a super cycle. So I think the nuance involves separating the short-term cyclical impacts of COVID in particular from the long-term structural trends, and perhaps we can talk about some of those as we move through the discussion.
Thanks, Stephen. And David, where do you sit on this debate?
Yeah, look, I have a similar view to what Stephen's just said. I think the super cycle sort of tagline is a little simplistic. I think there's some commodities that I think will perform very strongly, particularly those aligned with the energy transition, so sort of nickel, copper, lithium, because you've got a whole new sort of demand source overlaying those markets. But, you know, iron ore, as an example, you know, it's very hard to call a super cycle for iron ore going forward. So I think, again, as Stephen said, I think it is more nuanced. Perhaps the other point I'd make is, you know, what we've seen over the last year is those energy transition metals, you know, recover pretty strongly. But what we're seeing now is it's, you know, the commodities that are performing best are actually, you know, oil, gas, and coal, which really go against that. And I think you may well see a strength in those commodities because supply is coming under pressure because no one's really investing in those areas. And we're seeing that now with prices moving high as demand sort of kicks up as we head into the Northern Hemisphere winter. So I think that's another interesting aspect. But in general, I think it'll be nuanced.
Thanks, David. And then to complete the set, over to you, Jason. How are you feeling about this being a super cycle or not?
In our opinion, there will be a sustained increase in demand for certain commodities over the next decade or two. And there is also an increasing difficulty in meeting that demand due to constrained supply for certain commodities. So our view is that as a result of which, the price of certain commodities will graduate upwards over a sustained period of time. That's driven by, in our view, two things. Net zero. We think net zero has changed everything. We now have more than 197 governments that have signed up to net zero or a material reduction in carbon over the next few decades, whether it's 2030, 2050, 2070, doesn't really matter. But we are past the point of, in our view, no return. So the energy transition, the decarb, I think will mean we are short on certain commodities. Not all, but certain. And one of those would be copper, and we can talk a bit more about that. But if you can, you know, we are mining operators, and you know, on the supply side, it gets harder every single day. You know, even without net zero, it gets harder. And we're chasing these commodities all the time, and you know, it's tough. And we're seeing, you know, elevated prices and valuation graduating upwards. I think driven by that. The second key factor is major economies are continuing to grow. We don't see a major slowdown, you know, not really, whether it's China, India, Southeast Asia, and even US, a lot of spending going on, and we don't see that, you know, dropping off very quickly. I mean, one thing's for sure, we're going to see volatility. I mean, no one's going to say to you, you know, iron ore is going to stay at certain levels, or met coal, or whatever it is. But the trend, we think, is going to be pretty clear. So I think we're going to see this sustained increase. But again, you know, not for all commodities, but certain commodities.
Okay, just to sum up what I took from that first round of questions was, there is some aspects of a super cycle potentially, but this time it's a bit more nuanced, and it may be more commodity specific than maybe we've seen before, and connection to the energy transition seems to be a key theme. Thinking of commodities, it's very hard to think about commodities without thinking about China, which consumes over 50%, particularly on a first use basis, of many of the fundamental building blocks of our world. So over to you, Stephen. What's your view of China's role or importance within this next phase of the commodity cycles?
That's a good question. Thanks. Look, if we think about the 2000s, China's economy was a smaller proportion of the world economy, and I guess now it's either the biggest or will soon be the world's biggest economy. And over the last decade, we've seen that play out in trade tensions with the US. That all started well before COVID. You know, we've seen it play out in a huge amount of Chinese investment overseas. But commodity by commodity, you know, I think the role of China is going to drive investment in different ways. And so certainly if you look at iron ore, I think there's certainly an interest in China of doing more offshore now, particularly with what has happened with the majors and the iron ore oligopoly, if you like, and what's happened with recent price rises. So I think we may see China become more active in the upstream in certain commodities like iron ore, and perhaps there's projects in West Africa which will finally get built that have been proposed for the last decade or so. But then you'll see other commodities where I think the market becomes quite bifurcated, and one of those is the critical minerals. And so we've already seen this play out with separate supply chains developing, China, non-China, the US with their 43 critical minerals directive. I think just this week, Australia announced a $2 billion critical minerals facility to be managed by Export Finance Australia. And one of the companies I'm involved with in Cango, which has a sort of a BFS stage project in Malawi. The decision for them has been at that point, at that BFS point, are they building a supply chain for their concentrates into China to get processed downstream, or are they building a supply chain outside of China and into Europe? And those sort of decisions for development projects need to be made, almost pre-funding at the feasibility stage. So I think that's kind of changed versus where the world was 10 years ago. And I think also there are other countries such as Indonesia, for example, which also want to see further processing in country. Bauxite, for example, nickel ore in Indonesia, but they're two ores, if you like, that the government wants to see further process to add value in country. They want to see the investment coming in country rather than lower value products just being exported out into China. So on the project development side, that's what we see. And then there's obviously been a lot of noise in the last week or so on the China side with the energy story there. We all know China's trying to transition. They have targets around energy intensity that they're trying to achieve. But frankly, their grid, and it's the same in many countries, their grid isn't heavily developed enough yet to transition to renewables. So we're seeing these issues around their power supplies and their inability to really bring enough coal into the country to get what they need through the upcoming winter. So there's a lot of complex issues there within China. So I'll let some of the other panelists talk to the point.
Thanks, Stephen. I think there was a couple of really interesting themes there that I think we've looked at previously as well, such as the China outward investment. This time it is certainly different. And I think the increasing role of nation states looking to ensure that they take as much as they can in terms of processing before it leaves the national borders. Jason, how do you sit on this issue? Where do you believe, or what do you believe the role of China is going to be in this next part of the cycle?
China will absolutely be a very, very major influence, and in my view, the biggest influence around this commodity trend, but not the only one, because energy transition, decarbonization is a global revolution, and that's why I can say I think this time it's different, right? It's not just a single economy. You have multiple economies, and as Stephen mentioned, which I agree, Indonesia, very, very key. A lot of capital out of Indonesia going into different projects in Australia, a lot going on in country. Anyway, coming back to China, for a few reasons. One, as you said, it's the biggest consumer of many of the commodities. Really quite dramatic when you think about more than 50% of all the most of the major commodities, including gold, by the way. So that's one thing. But if you then look at, the biggest manufacturer of solar panels, the biggest manufacturer of battery, one of the most advanced technologies and innovations occurring in China on battery technology, it's China. So you look at energy transition, they're very much, at the forefront. Then you look at spending and look at their growth. So when you put all that together, you clearly would say they're going to be a major influence. But again, as I said earlier on, this whole energy transition is a very global revolution, and Europe at the center of it, of course. But everyone's catching up to that. So while China is a major influence, we're going to see a lot of other factors at play. Then coming back to also supply chains, the recent 18 months, I think it's quite clear directionally, at least in the short term, we're going to see a fragmentation of the supply chains, narrowing of the supply chains, and in our view, that makes the whole supply-demand equation more acute. Therefore, suddenly it can be harder to get supply, and suddenly everyone wants to control supply chains. So we think supply is going to have to play catch up for quite a bit of time. So we're going to continue to see China outbound investments again now a bit more nuanced. A lot of action happening in Africa. We have a mine in Zambia. We look around Africa all the time, and the Chinese investment in Africa is quite dramatic. And interestingly, the new Zambian president was met with the White House. I think it was last week. So lots of things going on, lots of competition, and that again would mean, I think, you're going to see a more positive outlook around, metals and mining sector.
Thanks, Jason. I think the regionalization there of certain supply chains is definitely something that I've been thinking about, and we've been thinking about as well. And we're seeing it particularly, I would say, in some of the battery metals with some of what's going on there. So the next question I'm going to throw over to Sam and then David in that order, and it's really, which commodities do you think are going to be seeing the biggest benefit, both from the super cycle, if we're a believer, or the energy transition more in general? So I'll start off with Sam. What's your view? Which are the horses that you're kind of backing, I suppose, for the next period?
Yeah, look, I think that the themes that underpin that have already been discussed by some of the other panelists. Obviously the green transition, the energy transition, low carbon transition, whatever you'd like to call it. It's clearly underpinning the battery materials, other base metals as well. I think we're just quickly coming back to China. Obviously, there's mention of the sort of green transition there, but also there's the broader thematic that's probably been going on for longer regarding transition to more a consumption-based economy and a construction sort of infrastructure-based economy. And David mentioned steel and iron ore as perhaps being areas that it's very difficult to get excited about going forward. So look, I definitely agree. The key base metals, copper, nickel, as well, the battery materials, and then with regards to the energy comments before, just very recently we've seen a bit of excitement in the uranium space. Now, look, arguably that perhaps has been driven more so by financial players rather than fundamental buyers, but I think that there's a good fundamental story behind uranium, and certainly in our own interactions with the investment community here in the UK, I think there's been, over the past 12 months in particular, an increasing acceptance that nuclear has a very, very important role to play in that low carbon future, whereas perhaps even 12, 18 months ago, there was a lot more resistance to nuclear being part of the energy mix, or a significant part of the energy mix. But I think that people who have been on the fence are now changing. So I'd probably throw uranium onto the list that we've already talked about a little bit.
Thanks, Sam. And David, where are you seeing the opportunities currently within the market?
Thanks, Charlie. Yeah, look, we see the opportunities in lithium, copper, nickel, and particularly nickel sulfate, and then some of the other commodities linked with the energy transition, like rare earths and graphite, but often they're harder to find sizable and scalable players. as Sam touched on, I think there's also, potentially opportunity. I think that one of the issues is reliable baseload power through this transition phase, and how you get that. And uranium's one opportunity, but looks like in the short term, it's probably gas as a transition fuel potentially, and even things like met coal on the steel side are looking very strong. So I think it's really across the board. I think some of the older, the fossil fuels will benefit because supply has been constrained and there's nothing quite ready to take its place. And then more generally, I think what we're entering, and your previous question was talking about China, I think we're entering a period of greater tension, and I think gold will play a role there as a defensive asset class. So we also kind of like that as part of a portfolio.
Okay, and I think we're doing well for time, so I'm probably going to throw this question over to Stephen and Jason as well. So, Stephen, where are you seeing opportunities within the current market and potentially within the super cycle as a whole?
If you look at Noble's business, I guess we're a trading company, and our core business has probably been in some of the more traditional commodities, so supplying into the steel complex in China, supplying coal into Asia's growing demand for coal. And I think if you look at last year and the stimulus that came out of China, it really drove the steel sector initially. So that was an opportunity for us, particularly on the inputs into that sector, being metallurgical coal and coke. But this year, it's really been the story of the energy sector, and particularly the last couple of weeks. But from our perspective, we saw that sort of starting from early this year. If you look at thermal coal, it was below $50 12 months ago, and this week it hit 202 at Newcastle. So that's an all-time high. The previous high was 201, and that was prior to the GFC. So we've seen some astonishing moves in the energy sector. As we know, a lot of this has been driven by shortages of gas in Europe. It's been driven by Chinese issues around power. Some commentators are calling this the revenge of the old economy, and I think what's really happening here is, whilst people want to move to renewables, there's a lot of catch up which is being played in terms of the way power grids are structured globally. And whilst in regions like Europe, where the grid's quite interconnected, and you have an emissions trading market that kind of works, in many other parts of the world you don't. And in parts of Asia, there's still new power plants being commissioned that run on thermal coal. So I think the transition is going to take longer than people may hope. I think that's going to create opportunities. I think there's going to be a continuing lack of investment in the fossil fuel side for ESG reasons, and there'll be players who stay in these traditional businesses and actually make quite a lot of money out of that. And I hate to mention one of our competitors, but Glencore's probably one of those companies. If you look what they did a few years back, they bought Rio out of the Hunter Valley with Yancoal. This year they've bought Anglo and BHP out of Cerrejón in Colombia, right? So for those who have the capital to stay in parts of the commodity sector that aren't being reinvested in, I think there are opportunities. But obviously over the longer term, we still assume those will fade, and there are obviously opportunities in batteries and whatnot, and critical minerals that we're also involved with through some of our investments in more emerging players. Thanks.
Thanks, Stephen. Jason, to finish off on this line of questioning, where are you seeing opportunities at the moment?
At the top of our list is copper. We've always left copper. And even before, I think it was acknowledged as at the center of energy transition. It's got multi-use, it's in everything. that we need to electrify the world, again, even before energy transition. And now with energy transition, electric vehicles use 3 times more copper than traditional, fuel combustion engines. So lots of data now to support. We kind of need to double the supply of copper, right, over the next 10 years to 2030 and beyond. So how do we get that? It's pretty difficult without something like trillions of dollars of investment over the next 10, 20 years into more copper supply. So I think it's very much at the top of our list, very hard to find high-grade, large resource, long-life copper mines, not that simple. So that's, we are very positive on that. We like met coal. Again, very difficult to create new supply. And then we've seen so many new developments being knocked back either by regulators or technically or whatever else. All the met coal basins around the world are pretty well known. And I think developers have found it very, very difficult to develop new mines. So existing mines will become more valuable. And you've seen a spike in the price. I mean, we're not thinking it would stay at $400 per ton, hard coking coal, but it's going to be longer than, and the long-term price is going to be higher than I think most brokers have forecasted. And I think we've seen an uplift in the long-term forecast. So I think that tells you a lot, notwithstanding the sort of current geopolitics around China, Australia. A lot of the met coal markets have rebalanced, and hence, in recognition of short supply, the price has, spiked recently. We like potash, Charlie, and we've been in potash for a long time. We've got 2 potash projects, one in US, one in Europe, looking for more, but very, very difficult to find. Again, we've seen recently potash prices spike, and again, these are all the short-term volatilities, and we're not suggesting these prices stay, at those levels for long-term. But certainly the trend, I think, it's going to be pretty clear. I mean, there's only one way to feed the growing population, and going to have to make arable land more efficient. We like polymetallics, so anything with multiple metals is a good thing. We owned a mine called Golden Grove in WA. We vended it into the ASX recently, and it's going to go well. Always go into something which has multiple metals, and that gives you a good buffer and downside protection. We like gold. We don't think, unfortunately, peace and it's going to break out around the world very, very soon. So there's going to be a lot of still volatility, and gold for that reason, I think, will traverse upwards still. In the battery minerals, the 2 things we are thinking pretty hard about is cobalt. Lots of cobalt in Australia, but I think eventually, the capital will go to cobalt, which is, reliably sourced, sustainably sourced, and from jurisdictions that has a very high ESG standards. So I think that's one of the metals that would be interesting. And nickel, I think, as David mentioned, we like nickel too. Smaller markets, difficult to find, but something that will play very well into energy transition.
Thanks, Jason. I think that was a really interesting rundown of a lot of opportunity, but I think you also covered some of the threats that exist within our markets, such as grade qualities, the ever-present geopolitical risks. And I was going to ask the other candidates as well what they see as being the key mid to long-term risks. So I'll start with you, David, if that's okay. Where do you see the kind of threats to a super cycle, and where do you see the kind of threats to the commodity markets in general?
Yeah, look, as we've talked, to me, the key theme for commodities and for the resource sector is the energy transition and the increasing demands for copper, nickel, and lithium. And basically, I think the biggest risk is the inability to supply the demand. What you're seeing now is, for example, all the auto manufacturers are jumping on board saying we want to move into EVs, we want to move very quickly. And I think from a public perspective, people want that to happen. But while it's relatively easy to build a gigafactory, it's not as easy to find and develop a copper mine or a nickel mine. And I think ultimately that's the big challenge, is and doing it in an ethical and efficient way, right? So to me, that's the big challenge: is can we actually deliver the resources that are required to drive the energy transition? And I think that's critical. And it probably raises issues around technology and can we explore a bit better with new technologies? Can we mine a bit more efficiently, and can we process stuff more at the mine site? So you're reducing the amount of transport and things like that. So they're probably the key areas I'd touch on.
Yes, some really interesting points there. I think the additional capex spend, the ESG components of mines, and the length of time it's now taking to get mines up and running is trends that we've just seen running for years. And there does seem to be, a definite capex inflation that we're noticing anyway. Stephen, over to you. Where do you see some of the threats to any potential super cycle or the kind of mid to long-term future for commodities?
I think I've answered. This one. I'm not sure.
Okay.
Oh, sorry. The future threats. Yeah, I think.
Yeah.
Well, actually, if I'm thinking about, when I think about the long term, I think about inflation, and I think about interest rates, right? So if we think back over the last 40 years or so, we've really had a period of relatively benign markets since the last oil price shock. So I think that I don't really see the current environment of inflation, which has been COVID induced, breaking out into hyperinflation. I think generally demographics, aging populations will mean that the trends we've seen in the last couple of decades will continue. I think the adoption of technology will continue to force people out of jobs and keep wage growth under control. So I don't see a huge amount of inflation breaking out. What I do see though post COVID is that a huge amount of debt's been built up in the system. I think it's going to be very difficult for central banks to raise rates. I know there's been a lot of talk over the last few months about rates rising in the US and that driving rates higher and potentially slowing growth. But I actually don't see that with the amount of debt in the system at the moment, the central banks globally can afford to do that. And I think that's actually going to be positive for commodities and mining long term. If we continue to be in an environment where we've got low interest rates for longer and continuing government stimulus and liquidity in the system, there's going to be relatively cheap capital to deploy in riskier assets that require longer timeframes to develop, such as mines. So I'm actually reasonably positive on the longer term outlook for those reasons.
And Sam, over to you on the threats. Any really big ones that we haven't mentioned that you guys at Canaccord are looking at?
I'll be fairly brief, because I think most of the other panelists have covered it fairly comprehensively. But obviously, I guess China's ability to continue to manage its economy and manage growth and transition, through both the energy transition, the consumption transition that we mentioned before. These aren't insignificant changes to an economy. So I think they've shown a very good ability to manage those things and keep demand ticking along. The ability to do that is obviously key. And then I think I'd just come back secondly to the point I made in my opening comments around just the importance that the supply side maintain their discipline with regards to capital investments. As I say, it's been, for the most part, the investment community is forcing management teams to remain fairly selective in what they invest in and make sure they're high returning projects. Obviously we see that loosen and a little bit of a return to what some may perceive as a traditional way that mining companies work when they get a bit of cash in their back pocket. That potentially could lead to some risks in certain areas, perhaps not across the entire commodity spectrum, but potentially there are some more at risk than others to that sort of dynamic.
Okay, thanks, Sam. And a quick question for Jason now. Jason, what's your view on how long this kind of business cycle, this current cycle, is going to last? Are we set in for the long term now, or is this a more kind of 1, 2, 3 year, more kind of regular business cycle in your guys' view?
In our view, it's going to be more than 3 years. I think we are fairly positive on that. It's going to be volatile. But again, we're looking at a multi-decade structural shift, I think, in the sector, driven by, the two key things, which is energy transition, decarbonization, and the continuing growth of the big economies, right? China, India, Southeast Asia, US, and Europe. I mean, they're still growing, and they will continue to do so off a bigger base. So we don't think it's a short-term phenomenon, but it will be volatile, and that's for sure. The one threat, I think, to the commodity sector and specific commodities is going to be around substitution, because if you can't supply enough to get to the end game, by definition, the market's got to find substitutes, right? Whether it's iron ore, whether it's coking coal, or whether it's copper, people have to find a way to overcome the shortness in supply. So if it gets too crazy expensive, then I think that would create perhaps another sort of dimension to the demand. Our view, substitutes for something like copper, pretty difficult because copper has multi-uses. So you might be able to find substitute in some sort of wiring, perhaps, but you can't find it for other uses of copper. Met coal, I mean, people are looking at all sorts of technologies to make steel, without met coal, but we think those technologies are some time away. So I think we're going to see. Our view would be a more than 3 year period of demand increasing and more difficult supply.
Yeah, I think substitution is a really interesting point that you raised there. I think if you look back at the copper market versus the aluminium market, then certainly aluminium demand growth has vastly exceeded that for copper, particularly earlier, well, maybe 20 years ago, when you saw some wholesale shifts in, say, automotive air conditioners, or move to optics from external data cables within the copper market. But I do also agree that a lot of the kind of low-hanging fruit in that market has already moved. So yeah, an interesting angle to this is going to be the interplay between the commodities themselves. David, in your view, how long do you think this is a short kind of business cycle, or do you think something more serious and long-term is set in for commodity markets?
Yeah, look, I think you got to look at what the key drivers are. And to me, there's really two key drivers at the moment. One, you've got the massive stimulus resulting from COVID, which is a multiple of, probably 3 or 4 times what the stimulus amount was through the GFC. So that's obviously a key driver. And I think we're starting to see the wind down of that. So I think that'll roll off over the next couple of years. But the energy transition, decarbonisation trends, I think are at least 10 years and probably multi-decade. So, so we see demand for those key commodities, copper, nickel, lithium, sustaining, over a long period of time.
And then thinking about, I suppose, those batteries, any views from any of the panelists on, say, technology change within the battery metals themselves, and if there is any risks or potential rewards as a result of that? Does anyone want to pick that up?
Perhaps I'll just comment. I think cobalt's really interesting as its role in batteries. I think manufacturers would like to have it in there, but I think increasingly they're prepared to perhaps design it out if they can't see a line of sight to long-term sustainable supply, which obviously comes from pretty unstable areas at the moment. So I think that's a potential risk. I think Jason mentioned, ultimately if prices of core commodities increases to a level, there'll be a move to substitution. And I think that's a risk potentially for nickel at some point as well.
Okay, and I suppose one thing that is certainly sitting in terms of I suppose the risk bucket is I suppose the decarbonisation question in terms of a kind of, are we on course for a 1.5, a 2, a 3 degree world? So in terms of decarbonisation as a risk or opportunity, where do the panelists see it as a driving force within this cycle? Happy for anyone to take this.
Yeah.
I'll have a go if you like. I think the debate around decarbonisation needs to evolve. I think if we look at ESG and that acronym, gets used pretty widely. But I think the public debate on ESG needs to evolve and needs to broaden. I think there are people who can't differentiate that debate between thermal coal and metallurgical coal. There are people who can't differentiate the need for growth in electric vehicles versus where the inputs are going to come from, and the fact that needs a whole lot more mining. So that's one of my concerns in terms of how quickly the world can decarbonise and reach the targets that have been set out. It's the connections that the general public and people need to make in terms of their behaviours, and where that electric vehicle is going to come from, how it's going to be charged, where the wind turbines are going to be built, where do the inputs come from, and all these things, as all the fellow panelists know, and I'm sure Charlie, involve a whole lot more mining, and there are still people who don't seem to make those connections, or who are anti the development of new mines to achieve that. So I think one of the concerns that I have is the need for a more informed public debate around these issues.
I think, can I just add to that? I absolutely agree with all that, and I've had cause over the last sort of 5 years to be heavily exposed to a lot of the ESG investment community for various reasons and in various guises. And I think that Stephen mentioned the public debate, and he's absolutely right. But even amongst the theoretically more informed professionals, I think a lot of the ESG community initially I'd characterize more as coming from an ESG or a climate advocacy background rather than an analytical background. And for the most part, that was what was required 5-10 years ago to obviously increase the financial markets understanding, or at least acknowledgement of the risks and requirement for an energy transition. But I think now as we move through this process, as Stephen said, perhaps those with a more analytical background or a broader based technical background and understanding some of the limitations around the need for mine development, or the speed at which the energy mix or the generation mix can change, is vital, rather than demanding that everything happen yesterday. There needs to be more acknowledgement of the practicalities of how we move through this transition.
Thanks, Sam.
So,
anything, David?
Charlie, I'll kick in there as well. I mean, the way I look at it is, economics wins. So the transition will happen when economically it makes sense for it to happen. And I think, if you look at what's happened with the EV market recently is for a long period of time, people talked about it, but it wasn't cost effective. It wasn't cost effective for someone to go and buy an electric vehicle. We're now seeing that come into parity, you know, with internal combustion engines. And you know, I think over the next 5 years, we'll all be surprised about how quick that transition happens. I think similarly with renewables, for a long time, the costs were too high. They're now pretty competitive and you're seeing money flow into that. So, you know, I think government regulation is important and setting targets is really good, but ultimately it's business that will drive this. And that's often driven by technology change. And I think, you know, I think one of the real benefits, you know, that come out of COVID is just a lot of money going into those decarbonisation and energy transition areas. So, you know, I think we'll continue to trend that way, but it's going to be driven by technology, and ultimately markets will shift when it makes economic sense to do so.
Thanks, David. I think that's a good place to wrap up for today. For me, the key takeaways, I suppose, have been that there are certainly opportunities as we enter in this next phase. It may not be a true super cycle, in that it's probably not everything that's going to benefit across the commodities, but there's certainly some aspects of some fairly serious change that are going to take place. We are going to need to decarbonize, and materials are going to be an important part of that. But the challenges of getting those materials out of the ground does seem to be increasing. So with that, I would like to thank all of my panelists. I thought that was a really, really interesting discussion, and I look forward to speaking to you all later in the conference.